Now I request Ashok sir to please take the charge.
Yeah. Yes. Good evening, everyone. Huh. Yes. Yeah, till they fix up the presentation. Uh, I'm thankful to the organizers for inviting me. It gave me the opportunity to read the new Income Tax Act of 2025. Uh, the whole act is basically a copy-paste job with simplified language. So if you take up the old act, put it into AI and say simplify, it will give you the same result. Okay, so besides the fact that section numbers have changed and certain things which they wanted to tinker with, they have changed. Everything is the same. Even in certain cases, they had made errors. So the Chirag told you that there were 70 amendments in this budget to the new act, which is still to come. So you had 70 amendments to the new act, which is still to come. Is because they have missed out on certain things which were to be done. So even in a copy-paste job, they had done an error, and therefore they had to amend it. 70 amendments had to be done. Now, I'm not going to take too much time. Actually, the topic does not require so much of an analysis. Some part of the topics have already been dealt with by Nihar Bhai, and I'm going to just elaborate on that. As I said, the section numbers are only changed. There is regrouping. So what I've done is I've put up a chart of what is the comparable sections in certain cases. The issues remain the same. So the most important question everyone has is, will I require to file a new form 3CD for assessment year 26-27? The answer is no. You continue with the old 3CD, the same form will apply. So all the rules will, with regard to the Income Tax Act 1961, will remain the same. With regard to all the circulars, as Chirag has already said, all the circulars are applicable, all notifications are applicable. However, they've made, as I said, they have a habit of tinkering. So I have a completely different view to Chirag. I don't want them to do a lot of things to the Act. I'm happy that they are not doing too much to the Act, because if they bring up a new law, it'll be more dangerous than what it is today. Now you look at the Companies Act 1956 Act and 2013. What they've done to Companies Act 2013 is unimaginable. For everything there's a penalty, everything there's a prosecution. So if they have to bring a new act which they will draft and bring it, it'll be more horrible for all of us, and it is better that they just copy paste and amend the old act and make it a new one. So I'm happy with what they are doing today. What they've done is, so I'm supposed to deal with salary, house property, capital gains and income from other sources. Now in all these four, there is not a single change in section. There is a few changes which I'm going to discuss at length over a period of time. And there is one major change with regard to section 68, where they have converted may into shall. May was horrible enough. Now shall will make our lives more miserable. Okay. So we'll deal with it as we go ahead. So I require 1 hour 15 minutes. Hopefully I should complete. If you have any questions at any point of time, because I've been teaching, so I have this habit of taking questions. If you have any questions, I'm open to any questions which you like. So income from head salaries, the heads of income sees no changes. The provision of law of 1961 and new act 2025, there is reorganization of sections, and all sections with regard to salaries are put in one place. So like he said, with regard to trust, you had 11, you had 13, you had 115 BBI, and you also had 115 TD, which was at different places. You had 115 BBC, which was taxing your other things. Everything is clubbed together, put under 332 to 336. So, sorry. Sorry. Yeah, so similarly, with regard to salaries also, what they've done is they put everything. So you had sections which were varied on different places. They put it at one place. They've removed section 16.3, which was with regard to entertainment allowance. Now that entertainment allowance was an outdated section. It was allowed only to government employees. It was the maximum amount allowed was 5,000. No government employee could ever claim entertainment allowance, and therefore that was an outdated section which they had to remove. They've removed it in the new act when they brought it in. All other provisions of the old act remain the same. Even the rules which are there. So there are draft rules brought in as of now. Those draft rules, if you look at the valuation rule with regard to salary, so whatever was the valuation rule with regard to valuation of self-occupied, of house rent allowance, all those valuation rules with regard to house, whether you own it or the employer owns it, whether there is furniture, whether you're living in a hotel, all those percentage remain the same. If you have a car which the employer gives you, there is a valuation process depending on the CC limit of 1600 CC or more. That also remains the same. So the rules are also copy pasted in the same manner. There is no change in rules also. So to that extent, only thing which you have to do is get a comparative chart and see whether those which section you would remember in the old, which is the new section. That's all. There is not a single change in the entire salary chapter with regard to anything besides deleting 16.3 and regrouping, which I'll take it up over here. So you had grouping, you had section 1010 which talked about gratuity, you had 1010A which talked about commuted pension, 1010 AA talked about leave encashment, and 1010B which talks about retrenchment, and 1010C voluntary contribution. All these sections were relevant for all employees when they had retirement benefit. Those sections were lying in section 10. They have clubbed together and put it in section 19. So what they have done is they have clubbed together all those sections, put it in section 19. You had 16.2 and 16.1 and 16.2. 16.1 talked about standard deduction. 16.2 talks about profession tax. Whatever is profession tax paid was allowed. All that is come into section 19, which is clubbed together as one. Now section 19 is in a tabular fashion. So wherever there are too many sections put into one section, they give you a table and they make columns and they give you what is the deduction based on those columns. So therefore section 19 is a columnar form. They give you all the sections put together in one place. So what they've done is regrouping of all these relevant section into one. Now there are two other sections, 10.5 and 10.13A. 10.5 talks about leave encashment. 10.13A talks about house rent allowance. Now these are two deductions which are allowed only if you are in the old system. It is not allowed if you are in the new system. So therefore these two sections are still kept in schedule 3, not kept over here. The reason being it is an exemption which you are allowed only if you are under the old system, not under the new system. So all the new system sections are clubbed together, put in an order, in a line, so that there is no difficulty for people to read and understand them. So this is a comparative. Section 15, section 16 is converted into definition section, section 17, 18, 19. There is only a change of numbers. Otherwise, everything remains the same. Section 15, salary, same definition. Chargeability of salary, either on due basis or on receipt basis, whichever is earlier. You also have arrears of salary which gets into a third clause. that entire thing remains the same. There is no change at all. You then have definitions under section 17. Those definitions were in the form of 17.1 salary, 17.2 perquisites, 17.3 profit in lieu of salary. Those three sections are converted into numbers separately. Your definition of salary is under section 16, definition of perquisite under 17, and definition of profit in lieu of salary under section 18. Section 19 talks about all the deductions and exemptions. So exemptions under 16, there were 3 exemptions given to you: standard deduction, you had entertainment allowance, and you had profession tax. Entertainment allowance is removed, and you have standard deduction and profession tax, which is also part of 19. Besides that, all the 10.10a, the list which I have talked about, all those sections are put under section 19. It is given to you under tabular form. Any questions with regard to this? Now, what changes? Nothing changes in this. The issues remain the same. If there is any circular with regard to salary which defines how to calculate salary, that remains the same. There is a circular which says when you do it, deducting TDS under salary, do not give deductions for ATG. That circular still remains, and you are not supposed to give ATG deduction when you are computing TDS deduction for salaried employees. So therefore, all those circulars remain, all those rules remain the same. There is no change. It is only a copy paste job. Same salary chapter remains the salary chapter. You do not need to unlearn or relearn anything. Only thing, keep this chart next to your table. So when you have any issue, you can actually if you have any issue, you could correlate the sections as per this particular thing. Now there are certain issues. I have time, therefore I have selected a few issues on salaries which I could discuss over here since I am doing that chapter. So you have this very common thing where you have foreigners working abroad for certain months, then coming into India and working. You have the same problems for people who are working in India and then going abroad to work. So if that 182-day threshold is crossed, and he comes here and he somehow becomes resident, or even if he does not become resident, there is section 5 which tells you that if you receive certain income directly from the foreign source directly into the bank account over here, since it is received for the first time, that income would become taxable in India. That is section 5 provision. Now if that particular definition is taken up, and then you have employees who have worked abroad for a few months, they come back and work in India, that salary, what they worked abroad, is received in India. He is a non-resident. That salary become taxable to him because he has received? The answer is no. The criteria is salary gets earned when it is due. Sorry. Yeah. Salary is earned when it is due. So the salary, section 15 tells you salary is taxable at the earliest point of time, either on due basis or on receipt basis. Since that salary which is earned abroad, you have worked for that salary abroad, you have received that salary became due abroad, therefore that particular salary, though received in India, is not taxable in India. There are a lot of judgments to that effect. I'm not putting into judgments. This presentation and those judgments I'll circulate to the committee members. They'll be available to you. The next issue which you have is with regard to ESOPs. Now nowadays ESOPs is the most in thing, because you have startups who can't give its employees high salary. Therefore, how do you incentivize something? Incentivize an employee, you give them ESOPs. You give them shares which help you hold on them to your organization for a longer time. You also have foreign companies who give ESOPs to people working in India for those foreign companies. Now the question is, how do you tax those ESOPs? Section 17(2) perquisite tells you that whenever this ESOPs are allotted to a particular employee, that is the concession given to him is treated as salary income, TDS is deducted. So therefore, if I have a 100 rupees share which is given to me at 10 rupees, 90 rupees is my incentive, TDS is deducted, under 17(2) I get a TDS deduction. Now that is all okay, we have that. Supposing that shares are bought back. So sometimes foreign companies, even Indian companies, they buy back those shares. When they buy back those shares, they give you the money, whichever is the market price, they give you the amount and they buy out those shares, the company buys out those shares or someone else buys out those shares and you get that particular value of those shares. Now that, what the companies currently are doing is they are deducting tax at the salary rate. So I will not look at it as capital gain. Because I am paying it to an employee, I will deduct it as salary and TDS is deducted at salary at 30% or whatever. Now, is that amount taxable as salary or is it taxable as capital gain? The answer is the amount is taxable as capital gain because you had vested right in that particular shares. Those rights have been passed on to the company or to third person, and when you pass it on, it's a capital gain. There is a direct judgment also. I will circulate Mr. Sanjay Bavecha, Delhi High Court judgment, where they have said that this is taxable as capital gains and therefore the tax rate is 15%, 12.5% plus surcharge and not the normal 35% which you pay. So that is one issue. There is also one unique thing when you do ESOPs. So supposing your company allotted shares at rupees 100. Now you paid 100 rupees, you took your allotment, that is a lock-in period of 3 years, and after that in next year onwards that share price goes down to 10 rupees, it goes to 20 rupees and you really regret that you paid 100 rupees from your salary, hard-earned money. Now the company realizes this, the company will then compensate you in cash form. This is very common for foreign companies if the prices go down. Also sometimes the company wants to sell. So I as a promoter want to sell my company. Now if I want to sell my company, I am getting a huge price and it is not certain whether the new person who's coming is going to honor my ESOP commitment of 100 rupees or 200 rupees or whatever it was. Okay. So therefore, how do I go about it? I compensate my employee with regard to the amount which he's lost. Now that compensation comes in the form of a check. Now this particular amount which the employee gets, there is no transfer of shares. There is no, it is not related to your salary income. Now can that voluntary amount be taxable as salary or how do you tax it is a big issue. Now there could be 2-3 aspects to this particular issue which we have. One is that the employer, the reason the employer is giving you that money is on account of the fact that you could sue him for breach of contract or misleading you into buying those shares which is likely to be higher. The employer is getting a huge chunk of money because he is exiting from that particular company and therefore he feels that he should compensate something, or it is sheer out of his voluntary that he gives you that money. Now in either case, if there is an undertaking taken by the employer that this particular you will not file a suit against you, then it becomes compensation for not suing. Now if it is compensation for not suing, now 55(2)(a) has been amended. Any amount where the cost is not ascertainable is treated as nil. So please read the law before you say that BC Srinivasan Shetty applies and therefore no capital gain is not the story. You now have 55(2)(a) which has been amended to say that if there is any asset where you cannot ascertain the cost or cost of improvement, it is to be taken as nil and therefore this would get taxable. There are a few judgments which I will be sharing which say that any gratuitous amount is not taxable. Now these are old judgments. These are judgments where ICAI and certain high courts have decided that this gratuitous payment is not taxable. However, this according to me gets covered under 17(2)(3) voluntary payment received from an employer. So it is a profit in lieu of salary related to your salary income and therefore it would anyways get taxable. So therefore to say that it is exempt, I am fighting something where someone has taken as exempt and the assessing officer has added that amount. To say that it is exempt is not a correct position of law. Coming to the next issue. shares of a foreign company. Now, this is a very common problem, which is for all those employees working for IT companies of foreign companies. They get allotted ESOPs. Now, when they get allotted ESOPs, the best part of life is they don't pay anything. So, to send money from India to US or to UK, it's a process. Okay. So, therefore, what the company says that I am allotting you 100 shares, I will sell 10 shares, I will buy them out 10 shares, and the 90 shares amount I will give you from that 10 shares. Now, this is an arrangement so that he does not have to remit money from India to UK or US or whatever. Now, this has two implications. First, there is a sale of shares of foreign asset. You need to disclose it. You need to disclose the profit in your foreign asset schedule. Second, the shares allotted. As soon as they are vested on you, you need to show it in your schedule of fixed foreign assets. Majority of the employees which are there who have got these foreign assets, they are not showing it. Generally, these IT guys, they are so tech savvy that they file the return on their own. Now, if they're doing it on their own, so much the better. But if you are doing it, please see that you disclose in the foreign asset and you take an undertaking that that is the only foreign asset left with him. Okay. So we as chartered accountants should be very careful when you file return. Gujarati ma kehwat છે કે હલકું લોહી હવાલદારનું. એટલે whatever happens, the first guy which will get beaten up is a chartered accountant. So one has to see that whenever you file even an income tax return where the information is coming from the assessee, you send a mail saying that do you have any foreign asset, do you have any, and take an answer, yes, no, whatever. Take an answer. So if he says that, oh, I've told you orally I don't have any foreign assets, send a mail saying that as per talk with you, you don't have foreign assets, therefore I'm filing your return. Send that mail on your own if he is not ready to give you a mail confirmation. But see that you do it, because tomorrow if it backfires, he is going to come and abuse you saying that you didn't tell me there is a 10 lakh penalty, you didn't tell me there is a prosecution. So this is something which is very common. So therefore, if you have any employee who has a foreign asset or who's working for a foreign company who has got ESOPs, please be careful. See whether he has actually sold any, whether he's remitted something to get those shares. Now, if he's not remitted anything to get those shares, that means either on the full value TDS should have been deducted because that is a grant to him, or if TDS amount is less, then there should be some sale of some units which you need to record in your return of income. So please be careful about these aspects, because my office deals with it and it becomes really bad when actually a prosecution notice comes in. Okay. So the first thing is you didn't tell me, you know. The first allegation which will get put on you is you didn't tell me, you don't know the name. Work. Yeah. Yes. Yeah. So India follows, see, if you have a foreign company, option granting should be disclosed according to me. So my principle is when in doubt, disclose it. Foreign asset hai. Okay. When in doubt, disclose it. But certain foreign companies have options which are basically granting. So there is no two steps in foreign companies: option granted and vesting. See, they don't have those two steps. So check whether they have that option granting and vesting. So if there is two steps, then you can do it at the time of vesting, not at the option stage. But certain foreign companies don't have that two step. Option granting is vesting itself. So check that literature which is given to them with this thing. And sometimes they say that we don't have it. They have a login ID where they can go and see it. Majority of the companies give them a login ID where they can actually go and check their status, because they don't have an HR which is have employees like us. So therefore they would have something like an online system where they could see what is their vesting or logging and what type. Okay. Yeah. So coming to income from house property, again no change in the law. The same provisions continue. The section only regrouped. The new finance bill, however, makes two amendments. So The new law itself has made two amendments immediately. The first one is 21(5). Now this is something similar to what we had, the act you have that if there is, if you have some, a property, you are a builder and you have property which is, there is an OC received and you have, that property is taken at nil value for 2 years, and after 2 years you are supposed to pay as a deemed let out property. Ansal Housing was the judgment. Thereafter an amendment was brought. Ansal Housing High Court, Delhi High Court had said yes, it is taxable even for builders where they have inventory, which that inventory is lying idle after the OC, that would be taxable. The government came out with the help that 2 years I will not tax you, after 2 years I will tax you. Now that particular amendment is brought where they had, the only change of word is the term used was for 2 years, and instead of that they replaced it with up to 2 years. There's no change. Only thing they felt that for 2 years would be misused, and therefore they say up to 2 years we will use, and that's only a language change. The 1961 Act had the term up to 2 years. Therefore, they said that we will replace it by up to 2 years in the current law. That's all. There is no other change which is there. As I said, copy-paste errors are being corrected. 70 errors of such nature have been corrected in the current this thing. The second amendment is with regard to section 22. This is similar to your section 24, deduction for income from house property, maximum deduction of 2 lakhs. So if you have an income from house property where you have self-occupied, the maximum deduction which you could claim is only 2 lakh rupees. If it is after 1/4/1999 and the construction is completed after 5 years. So then in that case, the maximum deduction you can claim is 2 lakh rupees. That 2 lakhs always included the prior period interest. Now what is prior period interest? If I'm constructing a house or I'm constructing a bungalow, and before construction I've taken some loan and interest is being paid, that interest had to be accumulated till you get the OC, and after that, that prior period interest is divided over a period of 5 years. Now when they drafted the new Act of 2025, they by mistake had said that 2 lakh rupees would be allowed, and also the prior period interest will be allowed for the deduction under income from house property self-occupied. Now that was never the position in the 1961 Act. 1961 Act said the maximum deduction available for self-occupied property was 2 lakh rupees. So therefore they amended the law and brought it to in line with the 1961 Act. And they said that prior period interest would also be subsumed in this particular interest of 2 lakh rupees. And there will be no additional deduction available to income from house property more than 2 lakh rupees. So as I said, they are going to follow, there is no policy change. They are going to follow the same act. It is just that to help you out, they've simplified the language, and that also for people who file their returns and read the income tax on their own. I don't think anyone besides us reads the Income Tax Act, not even the officer. So it is only for us that they said that maybe you're finding it difficult, so I'll simplify this thing. So there is a joke about a teacher says that you should do a good deed every day, and he tells the people that you should do a good deed every day. So the next day the teacher asked everyone, what did you do? I made the blind man cross the road. He asked the next guy, what did you do? I made the blind man cross the road. So everyone was at close. So then she asked, what did happen? So we took a blind man, we kept on crossing. We took him on the other side, we took him on the this side. So they kept on doing that. So this is for your benefit, because they thought that you were finding the Income Tax Act too complicated. Because besides us, no one else reads this Income Tax Act. And not with the passion with which we do. Yeah. Coming to these sections as arranged in this fashion, there is only a mismatch of numbers. Everything remains the same. There is a clubbing of sections 25 and 25A into section 23. Otherwise, everything remains the same. Only thing is the section number changes. Only the section number changes. Yes. Now, coming to the issues with regard to house property. So you had section 23(1), which talks about annual value. It tells you the annual value is either the reasonable letting out value or the rent received or receivable, whichever is higher. The reasonable letting out value, as in the olden days, was municipal value or the fair rent, whichever is higher, subject to the standard rent, and therefore you get your reasonable letting out value. You compare it to the rent received or receivable. Now the question that arose in this particular case was, in Mumbai today, there is no municipal value based on rentals. So from 2010, municipality has shifted to capital system. Under the capital system, the rent is arrived at based on the stamp duty value of your property. And therefore from 2010, there is no rental based municipal value. So what was happening in this particular company was, they had taken the municipal value, which was very low, and said that municipal value is low and a fair rent, and therefore I have taken municipal value over the years, and therefore the High Court has said nothing doing. That municipal value is not representing the fair market value, and therefore the fair market value has to be taken, and therefore one has to be very careful now. There are a lot of people who have multiple properties. If you have multiple properties, more than 2 properties, annual value you will have to work out, and you will have to work out based on market value. That market value, you might as well do it on your own. If you leave it to the assessing officer to do it, they have a unique way of calculating the market value, which is much higher. So therefore, if you have to estimate deemed let out property, it is better that you do it for your client and on your own, rather than the assessing officer doing it for you. Second issue in this particular judgment was, over the years we've heard that one cannot add the interest on deposits to the rental value. Here the Bombay High Court recently has said the affairs are put in such a manner that you have taken a substantial deposit, and that substantial deposit has gone to reduce the rent. So besides the market value of the rent, we will also take the interest which is there on the deposits, and they've approved that, which is a very, earlier it had not been done. This particular judgment takes that also into account. So one has to be very careful when you're working out annual value. Left to the assessing officers, they'll do a fantastic job. Can one claim the property was left vacant for the full year as he could not let out the property? So there is this concept of vacancy allowance. Now the vacancy allowance, you are of the belief that after 12 months, 2 months vacant hoga to mujhe deduction milega. But if I have, supposing, given on rent, I'm trying to give it on rent, and I'm not able to get someone whom to give on rent for the full year, can I say that I will not be taxed because the full year these particular judgments are there which say that yes, if you have made efforts to give it on rent, you are not able to find someone who is going to take it on rent, then that particular property you cannot tax it on deemed let out value. These judgments could help you. However, you need to show that some efforts were made to give it on rent. Okay. So this is something, these judgments were something which I wanted to bring to your notice. Then the last one, Chirag has already dealt with it. Supposing there is an amendment. So there are, he said, 10 Supreme Court judgments which are with regard to house property. The dispute is whether it is business income or it is income from house property. Business income allows you to claim higher expenditure. You can claim depreciation, you can claim collection charges, insurance, and you can be very creative about the expenses. I need not tell you, as chartered accountants, we are very creative. So therefore, the business income seems to be the thing. There were 2-3 judgments recently of Supreme Court where they said that if the purpose of the company or the firm was to give it on rent only, then in that case there is no question of house property, it is business income. That was the criteria. Now, therefore, this went on for quite some time. Everyone said that I'll amend my memorandum of association, I'll amend my partnership deed, put a clause. Because we are very creative, so we started amending. So the government amended the law itself. They said nothing doing. If it's a residential house, there is no question of business income. So they amended section 28 to tell you that if it is a residential house, then no business income. It has to be taxed as income from house property. Now the difficulty arises if supposing I'm running a girls' hostel. It is for the residents of the girls' hostel, but the question is it's a commercial transaction. It is my business to it. So I give them towels, I give them food, I give them breakfast, I give them cleaning facility, all those things, and then I give them, it's a residential premises. Can I say that it will be taxable as business income? According to me, yes, you can claim that it's a business income and therefore not taxable. Similarly, like the example which he gave, I do Airbnb. So if I do an Airbnb, I have people who do Airbnb because it's very profitable. So someone comes for one day, the whole month's rent is given in one night itself, or a 2-night stay gives you the whole month's rent. And it is up to you how many days you want to give it on rent. If you have some guests, you don't give it on rent, and things like those. So that flexibility is available to you. There also you give a lot of facility, you allow him to use your kitchen, you give him breakfast, you give him, there are a lot of facilities which an Airbnb also gives you. You have towels, it's like a serviced apartment only. Will that be taxable as business income? Depending on the facts of each case, it could be taken as business income. However, trust me, it will get to litigation. Again, you will have Supreme Court telling you how to do it. Okay. So, but as far as the girls' hostel is concerned, we have given an opinion that it is business income because it's something which is done in a very structured manner. Okay. So this is all about issues in income from house property. If any other issue, you can always raise it and I'll answer them. Capital gain, again, absolutely no change. Verbatim, section to section, there is a long list, so I have not put the comparative chart because there are so many sections I can't. It is available in your text, in your act. A comparative chart is there. Verbatim, the same sections, the same language, the same errors which were there in 1961 are carried over here. There is no change. Okay, they've done a very good job. So I'm very happy when they don't do much. If they do something, they'll bring out the Companies Act 2013, they'll come out the Money Laundering Act, they'll get you the Benami Act, which will make your life more miserable. So it is good that they are not doing much and they are simplifying things. Okay. Coming to buyback of shares. Now, sir has already dealt with it. I'll just spend a few minutes over here and then we'll go ahead. These slides will be circulated. I've already given it to them. You need not take a photograph. It will be in your folder before you go back. Okay. So there were the buyback of shares is the favorite whipping boy for the government. So they feel that all planning is done in buyback only, and therefore they had first targeted it to say that it will be taxable as in the hands of the company under 115 QA, saying that the company will deduct 20% and it will be exempt in the hands of the shareholder, 1034A. That went on for some time. After that, they said dividend will be taxable in the hands of the individual. Now, they forgot to amend the buyback provision. So therefore, they suddenly realized that so many people are doing buyback, they are not paying taxes, though they were paying taxes in the company. The government always felt that buyback is something wrong. So they amended it in 11024. Now, when they amend something with the intention to block you, they do a superb job. You look at your 45.4A. 45.4, you look at 9B, they taxed it twice. They didn't know what was the section, they amended it. They actually understood that it's not workable, so then they amended it at the time of coming out with an act. They still don't know how it works, but that apart. So 45.5, 45.4 and 9B is the most beautiful, it's the most complex thing you can have. Then you have rule 8AA, which will tell you how to distribute double taxed income. Okay, so we have session after session every time, and then you again forget about it, and then you learn about it. So actually people have stopped using partnerships as a mode of planning so that you don't get into double taxation. Okay, there are modes also, but we are not on 45.4, so that I'll not discuss that at this stage. So therefore they came out heavily on 110/2024. They said everything is dividend. Whether it is from your capital also, I'll treat it as dividend, and therefore they brought in 222F. And they said that I will tax it you will get taxed at dividend. Now that was the situation. The smaller shareholders became unhappy. There was a huge UN cry, and they said that the cost will be allowed as carry forward loss. I should have some profit to take a carry forward loss set off. So therefore this was a very precarious thing. There was a lot of UN cry. and they amended, and then there was a stopping of all buybacks. So I think few buybacks of major companies failed because of this particular provision of law, because it was not feasible to get into that taxation. Okay. So the amendment was made, representation was made, and they suddenly realized that this is not workable. There's a lot of resentment, and therefore they brought in the new buyback rationalization. Now buyback rationalization they bought, वो अपने में कहवत है ना मियाँ पड़े पर तंगड़ी ऊंची ने ऊंची. So they said that nothing doing. We will not allow that to promoters. The promoters will have to pay higher tax. Now, how do you bifurcate promoters and non-promoters? Anyone which has more than 10% is a promoter. Okay. So practically in private limited companies, everybody is a promoter. Okay. Because it's a family-owned company. So you can't go for a buyback in a family-owned company. Okay. Unless you plan it that way that everyone holds 99% and then you have a, so there are dirty plannings which can lead to a situation where buyback will be less. But then with the over a period of time, that does not work. Okay. So a lot of people do plan that everyone has less than 10% so that there is no deemed dividend application itself. Okay. So therefore, there are a lot of companies who do that. Now, they amended the law. They amended the law and they said the promoters will have to pay higher tax. They decided companies 22% and others 30%. And they said that additional tax will have to be done. That table is available over there. And this is the new law which they brought in. The bill has not passed, but it will get passed in due course. One second. Yeah. Now the capital gain transfer on way of redemption of sovereign gold bonds. Now this is another thing. As soon as they come to know that you are making some money, they want their share. Okay. So they initially, the whole idea of bringing sovereign gold bond scheme was that you should not buy gold and keep it in your lockers. You should let it develop the economy, and therefore we will give you a capital gain exemption. We will also give you 2.5% interest, and therefore please come, don't invest in gold, invest in sovereign gold bonds. Now first it was 2015. The idea was 2015 was exempt. Okay. The act gave exemption only, 47 gave exemption only to the 2015 scheme. After that there were various schemes coming out and everyone said that is also exempt. Now I don't know how that idea came that that is exempt without reading 47, but everyone said it is exempt. Government also said it is not a very big sum of money. Let us keep quiet about it. Now then they started earning more because the gold rates go up. Okay. Now when the gold rates went up and they said that all this profit was going to an individual's hand, they suddenly realized that, oh, they're not paying tax on this particular amount. Okay. So therefore they commended the law and they said that you will get a deduction only if first you have held you are the original subscriber and you hold it till the end of the scheme. Okay. Then only you will get benefit of it. Otherwise you will not get benefit of it. They also clarified that all gold schemes are exempt. Okay. So whether earlier it was exempt or not, they keep quiet about it. But since now it is exempt, earlier was also exempt, let us presume, because they are not reopening and harassing you. So therefore, let us assume that all gold schemes in the earlier, other than 2015 also was exempt. They've clarified as of now that they are exempt. Now, this makes that entire scheme of gold bonds less incentive. There'll be a lot of issues. Supposing I get a gift from my father, my inheritance from my father, if I have bought it, how will you decide as to whether I was the original subscriber and therefore it is exempt? Now you bring in something which is not workable. So how in an faceless system where you file your return, you claim it as exempt, how is he going to track it? And if supposing these 500 or 400 people claim, everyone decides to claim it exempt, how will he is going to track that? Okay, एक जो पकड़ा गया उसने taxable अच्छा tax भर देते हैं 200% के साथ, बाकी 400 निकल जाएंगे. So how will you implement it? Unless you have some tracking system. So hopefully they must be having some tracking system. As of now, I'm aware that they don't have it, but maybe they'll develop something. So amendment will apply from 1st April 26 and hence applies to redemption of SGBA from 1st April. Exemption is restricted only to original subscribers. Issue may arise whether the person who has received SGB by way of gift, inheritance, I've already dealt with that. Legal heirs. Exemption is now only by redemption on maturity. No exemption is available in case of premature redemption or transfer. Yeah, I think I've covered everything. Yes. Yeah. Anything, any questions with regard to any of the things which I have done, please feel free to ask me. Now, coming to the definition of relatives. Okay. So, the definition of relative, you have lineal ascendant and descendant. Now, definition of relative under 56 is really funny. So, you relative of one person need not be a relative. So, you have your uncle and bhatija ka thing where you have this conflict of religion. So, HUF is a relative or not, there's a dispute going on. Now, to add to this, they've added this. Sorry. So, they've added this. So, they've amended 241 and in the old act, 294 in the new act. The relative means in case of individual, any lineal, ascendant, maternal as well as paternal or descendant. So here they clarify that it could be your father's side or it could be your mother's side. So your nani could also give you this thing, your great nani could also give it. If it is linearly ascendant or descendant in the same line, it is allowed, there is no restriction. Now the question is, does it broaden any definition term? According to me, no. There is no broadening of any definition. It is only giving a clarification, or it was something which was already earned. It was already cleared to that extent. I have listed a few judgments. Byomke Chakravarti 39 ITA 303. An old judgment where they said that lineal descendant, what is a lineal descendant, and the grandson is a lineal descendant. There is no question of his not being a descendant. Similarly, they have clarified that it should be in the straight line. It could be from the maternal side or from the parental side. This is the three judgments. Similarly, Geeta Ben Vipul Bhai Shah, 270 ITA, the words lineal descendant would mean persons in the direct line of descendant of the deceased, such as child or grandchild, as contrasted with a collateral descendant. Wives of lineal descendants would obviously not be lineal descendant of the deceased. Wives are not included, she is not a descendant. Similarly, you have Dhanlal Devilal. In this view of the matter, a son will be lineal descendant of the mother as well as of his grandmother. So it is coming from the nani, that was held to be allowable. According to me, there is no new change. However, there is change in words, so I had to bring this out, that there is a change in language only to the extent of 2-3 words, but it is only clarificatory. This was always the situation. There is no change from the 1961 Act. Yeah, so 73, carry forward and set off of losses. Now, carry forward and set off of losses, you had the term assessee shall be entitled to have such loss set off against income as arrived under a similar computation in capital gains. Similar computation was something which was disputed. So what do you mean by similar computation? In one case I have indexation, in other case I don't have indexation. 50B slum sale, you have other forms of this thing. Can I set off those losses, gains and losses? Now, the language was such that there was a doubt whether that set off could be there. There was litigation. Litigation was in all cases was in favor of the assessee. I have listed those two Mumbai ITAT judgments and put it over there. However, in 2025 Act, they remove that. They say that such loss shall be set off against the income computed in respect of long-term capital gain for that year. So the concept of similar computation is removed. It is clarified that there is no dispute with regard to that, though there were 2-3 cases against which the assessee had to go and appeal and win. However, they've closed that particular dispute. They've said that whatever the computation, whether it is slum sale, whether it is indexed, whether it is not indexed, all those losses and profits can be set off. And therefore, this 73, the minor changes, they clarify it in favor of the assessee to that extent. Yes. The second issue is assessee shall be entitled to have. So the concept in the older law was that assessee compulsory had to set off that loss. What if I don't want to set off and I want to carry it forward? Do I have an option? The department was of the view that there is no option, it is compulsory. A better view is that set off is mandated and not a choice. So therefore your utility, today utility is more powerful than the law itself. It doesn't allow you to do what you don't want to do, you're not supposed to do. So utility does not allow it to do. The law clarifies, this section clarifies that it is mandatory, it is to be set off, and it is not allowed to be a choice where you take a carry forward. Okay. Yeah, 50%, 1% shareholding is equated qua person or persons. So you had section 79, which said that if the holding changed from 50% of the shareholding change, losses were not allowed to be set off. And the concept was, I've marked it in red, the term was persons, beneficially held by persons. So the language is where a change in shareholding has taken place during the previous year. In the case of closely held company, no loss incurred in any year prior to the previous year shall be carried forward and set off against the income of the previous year unless on the last day of the previous year the shares of the voting power were beneficially held by persons who beneficially held shares. Now the term used was persons. When they made the 2025 Act, they took it as person. They removed the S. According to me, it was a typing error. They accepted it later on when it was made that it is only a error which is there, and therefore you should not feel that we are trying to change the policy decision that supposing A and B were holding 51% and there's an internal shift where we exchange our shareholding. Does it mean that the loss is not to be carried forward? The answer is no. So therefore, the person does not mean one person, it means persons. And therefore, there is no need for getting into the examples which are there. We are at 8:15, I don't want to take it too far. So therefore, I'll skip the examples which are there. I am circulated, but that's not relevant because the term person includes S also, persons also. Okay. Clause 1193, they've clarified the Ministry of Finance response to this thing is clarificatory. They say that it's an inadvertent drafting error. However, they have not rectified this error in the budget this year. Okay. So can I rely on Ministry of Finance's this thing? According to me, yes, I should rely on it. They've given this thing. I can say that this thing, though I'm sure that we are all aware that their promises are not to be taken at face value. Okay. So PCS discussion support can be used for claim deduction. My answer is yes. The second issue is, supposing I was holding 60%. I incur a loss, and after in between I reduce my shareholding, it becomes 40%. In those years there is no loss set off. After 5 years there is a loss set off. At that point of time again my share is more than 51%. Do I need to look at the in-between years, or can I look at the first year and the year in which I'm claiming the loss? My understanding is that you only need to look at the year in which I'm claiming the loss. If 51% is still held by me, in between if there is a change, you need not get into that particular issue. Though there are judgments to this also. Like he said, there could be a dispute with regard to everything which we do. Yeah, common order for assessment and penalty. I'm strictly against this. Okay, so someone had said that this is for the benefit of reducing litigation and all those things. This is just their way of punching you, nothing else. Okay, so look at the situation. You have 270A. Now what does the 270A says? Whatever is your assessed value minus whatever was your returned value, that on that they can levy penalty. Either for under-reporting 50%, misreporting 200%. That is the law. Now when I am issuing a show cause notice, is there any assessment done? The answer is no. If I don't have that figure of assessed income, how am I going to levy a penalty? Now they have not amended 270A, but they say that we are going to come out with a common order, okay, as of now. Now that common order, and there is no extension of time. So the assessment has to be done in that same time. The penalty also has to be levied in the same time. He is supposed to issue a show cause notice in the same time to you. Assessment itself, we all are aware how they issue show cause notice. They give you 2 days, 4 days, 5 days to reply to a notice. And when you ask for adjournment, they behave as if you've asked there for a favor, and they'll give you 4 days further or something like that. So if to complete in the same period, I'm going to do assessment and penalty. First of all, you need to amend 270A to levy penalty for me. You can't levy penalty based on what you have done today. Okay. So therefore, it's another thing. The second thing is, there is under 270A, there is subclause 6, okay, which tells you that penalty need not be levied if there are certain conditions met. Okay, there is an estimation, there is a proper explanation, and there are some 6 items which say that this particular thing penalty will not be levied in spite of the difference if you meet those conditions. Now, if at the assessment stage you are going to levy penalty, that particular entire 270A6 will become redundant interpretation, because you will never agree to any of those estimation or explanation, because you are already issuing me a show cause notice. The question is that entire 270A6 will become redundant. Second thing is, besides this, you have also a situation where you have various other laws. So you have 275, which tells you a notice will be issued, a particular process will be done for levying of penalty. That has not been amended. So you have said that I will levy joint penalty, but you have not amended 275, which tells you the process of levying penalty. You have not amended 246, which says that there are separate appeals to be filed for assessment and penalty. There are separate sections. So what do? I get one order, I file 2 appeals, one for the assessment and one for the penalty. How do I go about it? Now all these things, they still have 1 more year. So this is applicable from 1/4/2027. So till then, some sense will prevail and they will amend it. Okay. So hopefully, yeah. But this is not for ease of anything. This is multiplicity of assessment, nothing of that sort. It is just to create my book. It's like I went to Davos and I made 1 lakh crore agreements. Okay. So I made an assessment and I have 500 crores worth in my books. How much is collectible is something which is different. Okay. So the penalty, it will create a lot of problems for listed companies. It will create a lot of problems for companies which are into funding, because what will happen is you will have to disclose what is the penalty amount which is there. In certain cases, you will not get funding. So if you are an ARC, asset reconstruction company, if you have such demands, it becomes a negative. Your people will not fund you for this. Listed companies will have to disclose in an LODR that this much penalty is levied on me, and explain why this particular penalty is levied. So this could really go into a really an obnoxious situation where you will have a huge demand because of the penalties. However, this talks about only 270A penalties. Other penalties are to be done only after assessment in due course of time. This is applicable only for 270A penalties with regard to the assessment. If there is a JCIT permission to be taken, you need to take that JCIT permission before you pass an order. Difficulties in common order, I think I've covered some of them. I think I've covered majority of them. Yeah. You have, I think I've covered everything. Difficulties, I can, chartered accountants. Yeah. So they give you a carrot with the stick. They tell you that, oh, you will have a lot of penalty, but we will not collect that penalty till the first appeal order. So therefore, penalty is not going to be collected till the first appeal order. They also reduce the 20% limit. So if you have today a demand, they say if you are in appeal, you pay 20%. They say that no, now we have reduced it. The finance minister said they've done it. They've not come out with a circular. Hopefully they'll come out after the budget is passed. That they say that they will little bit 10%. You had the circular 1914 of 1993, which said that 20% of the demand is to be paid when you are in first appeal. However, they've reduced it to 10%. They further said that 10% of only of the tax. So earlier it was 10% of the demand notice, tax, interest, everything. So here they say 10% of the tax only and not of the full amount. So they give you this particular benefit if there is a common order. However, they have not given the same benefit for transfer pricing. So when you have a transfer pricing order and you have to go to the ITAT, you are supposed to pay 20%. There they have said that they will not make it 10%, they will continue with 20%. I don't know why, but they have not done that. Yeah. Yes, going ahead. Yeah. I think Nihar Bhai has already dealt with it, 60% to 30%. My view is slightly different. That 30%, if you calculate, even if you show it in your return of income, you will have to disclose from where you got that income. Otherwise, again, it becomes undisclosed income. If it becomes undisclosed income and you are not able to explain the source, there is a chances of levying of penalty. So therefore, if you show it as income from other sources, you show that income and you pay a 30% tax. If supposing the assessment gets taken up, and he asks you what is the source of this particular income, and if you are not able to explain that source, my understanding is he will levy further penalty of 200%, and it will be more than what the tax it is. So as of now, if you calculate that 60% and all those, it is coming to more than when it was 60%. So 30% with 200% penalty is higher than your normal 30% is therefore not beneficial according to me. However, if used in the right manner, this could be a tax planning method to a great extent. That's like an amnesty scheme ever open in the Income Tax Act. If you say that 200% is not leviable and I need not show the source of that particular fund, this will be the biggest money laundering scheme ever, because everyone will just come, disclose, pay 30%, you are out. Now that cannot be the intention, okay? But that apart. So reduction in time limit for filing TDS and TCS. I'll not waste my time. There is a separate lecture for TDS and TCS. He'll be taking it. But however, 31st March is the due date. You will not be able to correct certain years TDS returns after this 31st March. So according to me, you should be more careful about it. Check for all your clients. If there is any demand, try to reduce it, try to address it, because the law is going to change after 31st March. Yeah, this is 102 unexplained credit. Now this takes the cake. So you had 68, 69, 69A, 69B, 69C and 69D. Now those sections had the term may. Okay, now they've converted into shall. A representation was strongly made by Chirag and the entire team saying that this is incorrect, we should use it as may. However, they said according to us may and shall are the same. Okay, so therefore we will take it as shall. Now you all are aware 68, they have amended the law. They've told you need to prove the source of source. Actually it is not source of source. You should read that language very clearly. So what 68 tells you, that that proviso tells you is I am supposed to show the I am supposed to identify that and the source of that fund. It's not source of source. I need not prove a next level. So if you read that language properly, it doesn't require you to do a lot of things. However, today the officer is saying you need to prove the source of source of source of source, and it should, if you ask the officer, he can go to the 9th level and find out where is the source of. So I actually have an assessment order where A has taken a loan from B. B says that she has taken a loan of C. The bank statement, return copy, everything is given. And then he disallows that loan under section 68 saying C bank has a credit of 20 lakhs which you have not explained. And therefore I feel that this 20 lakhs is incorrect. Now how can I explain something in C's balance sheet at the 3rd level? Now this is an order which has already come. Okay, so this is the practicality of life. You need to give the source of source and you need to prove it to a level where they are satisfied. That's a fantastic word. Okay, so to the satisfaction of the assessing officer, that source of source. Now if you want to really fight, they have an SOP for 68. They've actually, this was represented, and they have come out with SOPs on how they should, what is doubtful and all that. So you should look at that SOP, use it in your assessment to copy paste and tell them that the SOPs tell you that you are supposed to do this. However, whether they listen or not is a different question. But yes, you can use those in there. May was making our life miserable, shall will make our life more miserable. And it's basically end of any, so I'll tell you what happens. I'll give you an example because I just have replied to a 133.6 on Saturday, where a family friend gave a loan of 1 crore 30 lakhs to a family friend because he was in financial difficulty to bring him out. That fellow was worth crores of rupees, so he could give 1 crore. We both cannot give 1 crore 30 lakhs to each other, but they are industrialist people, so he gave 1 crore 30 lakhs. So they asked for a confirmation, they give my bank statement, I give everything. The 133.6 second one which comes to my client who has given the loan is that you are requested to let me know whether you are a paper company because you are not taking interest and you are giving loan free of cost. Therefore, you are supposed to prove that you are not a paper company by giving your books of accounts, your bank statement for the full year, and it was like basically my assessment was being done. Okay, so this is a reality of life. We need to face it. Any loan taking, so can you imagine I need money, I go to him and I tell him that please give me money. He gives me the money, I tell him give me your bank statement also, give me your source of source also. तेरे पास पैसा कहाँ से, मेरे को लात मार के भगा देगा. So this is a reality of life, but we need to face it. 69 to 69D, 68 to 69D has become 102 to 106. Two sections 69A and 69B have been clubbed together into section 104. There could be a session of 3 hours on this topic, so I'll not dwell more on this because the language used is a bit different than what is there, and there is a scope for some sort of arguments at a later stage. I think I've covered. Yeah, this is a ploy to shift onus. So when you have a shall, the onus never goes to the department. It's like a prosecution, 278E. You prove that you are innocent. So when you have a shall, the whole idea is it is something similar to your 278E in your criminal procedure. I don't know whether you done any criminal procedures. 278E is, the onus is always on the assessee to prove that he is innocent. Okay, so therefore this is something where you shift the onus from the department to the assessee forever, and you prove that source of source is there, and it is good. Okay, can I ask him to issue 5-10 minutes? I have 5. Oh, yeah. So can I ask the assessing, how do I come to know what is the source of this person? He is never going to give me, I have taken money from him, I am not even giving him an interest. Can I go to him and ask him, give me source of source? The answer is, the way to fight legally is to tell the assessing officer that I am a creditor, I have taken money from him, he will not share the return with me. So in the case which I told you, my client was not ready to share his high value return with the person who had filed, whom he had given a loan of 1 crore 30 lakhs. So how do you deal with it? You tell the assessing officer, please issue a notice under 133.6 or 131. Ask him to give details directly to you so that I am not involved in it. Can I do this? Yes. Is he bound to do it? The SOP tells him to do it. So there is an SOP which tells him that if such a request is raised, he is supposed to do it. However, if today he gives you a show cause notice and you tell him to issue a 133.6, that cannot happen. You are at the fag end. Okay? You did not tell him to do it. You kept taking time. You brought him to 15th March and then you tell him now you issue 133.6. He is not going to issue 133.6. He'll say you prove it. Okay? But yes, if you were in September, you were in December, you could always tell him that please issue 133.6, 131. You can still tell him. Whether he follows or not is a different question. But the principle is that you should be fair to both the sides when you raise such a request. But yes, you can ask him to issue a 133.6 or 131 to get the source of that particular person's funds. What happens if he does not reply? He is going to add it in your books of accounts. Okay? If your lender is very busy, he decides to put you in hot water, you are done. The addition is going to happen in your book, your hands, and the demand is going to be raised in your hands. So I'll skip this. Repeals and savings. So 536 tells you that if there is any provision which any proceedings which are outstanding. So you have the case where you have invested in capital gain schemes in the 1961 Act and you don't spend it in for 2 years. Is it that they are not going to be able to tax you? The answer is no. They will be able to tax you. This 536 tells you that the Income Tax Act continues. Even if this 536 section was not there, you have section 6 of the General Clauses Act. That section 6 of General Clauses Act says even if the law is superseded by some other law, that law will continue and you would have. So you have this, in the next slide you have a case law of the Supreme Court where you had Punja by this thing 186 ITR. When they were shifting from 1922 to 1961 Act, 1922 did not have any taxation of bad debts recovered. So you could claim bad debts, but when you recover it, that taxation was not part of 1922 Act. However, when they brought the 1961 Act, they included that particular clause in it. So there was a person who had claimed bad debts, and later on in the new Act, he recovered some money. His argument was that the 1922 Act did not have it and therefore I would not pay tax. The court said nothing doing. Section 6 of the General Clauses Act would apply and therefore this is doable. They have gone ahead and earlier 536(2) talked about if there is any violation and there is any tax leviable that was there. They realized that there are certain clauses there need not be any violation. Still you have to comply. And that could also lead to taxation. So they amended the law this time and that said that even if there is no violation, if there is some compliance to be done, and because of that compliance not being done, 2025 Act is capable of taxing you. Are the demands under 1961 Act collectible under 2025? Yes. Are prosecutions continuable? Yes. Are penalty notices continuable? Yes. Everything which could be done in 1961 Act can be done under 1925 Act even after repealing on 1st April 25. I think transition of rules. So I've already started with the rules. So whatever are the 1961 rules will continue to be the rules. Those rules will continue to apply. The rules do not get carry forward. So those rules, 1961 rules cannot apply in 2025 rules. So therefore they've come out with the new rules. When they notify or not is something different, but the rules are same as the old rules. So if you go to the AI, put in the rules and test any rule and compare anything, it'll give you the same result. Okay, unless they made a copy paste error like I told you. Okay, so they use the AI very extensively to draft this particular bill. So let's hope 1426 enables us to do a good job and ease of living prevails, at least for chartered accountants, hopefully. I was very happy to see so many people on a Monday evening at 5 o'clock. Means it was a shocker to me, but I was not weeping. I thank you very much for coming. Let us all have the strength to learn, unlearn. Thank you very much for this particular opportunity. Thank you.
Thank you, sir, for such a wonderful session. Members have got any queries? I think they understood what you said, sir.
Yes,
I request Pratik
so do I.
propose a well-deserved vote of thanks.
Thank you, Vijay sir. It's my privilege to propose vote of thanks to the third speaker of the session, CA Ashok Mehta, who delivered an insightful session. Sir, you have beautifully simplified one of the most fundamental yet practically challenging area of taxation. The clarity with which you have explained the nuances of income classification supported by practical perspectives and jurisprudence will certainly help all of us to strengthen our understanding of the subject. Your ability to connect technical provisions with real life practice makes the subjects more engaging. Sir, on behalf of Borivali Central CP Study Circle and WIRC, I express heartfelt gratitude for you to sparing your valuable time and enriching the knowledge of our members. Thank you once again, and I request all members to carry on.
Tomorrow's session will be on TDS and business and profession. The speaker will be Ravi Sonian and Avinash Ravani. So let us meet tomorrow evening at 5 p.m. at the same venue. Thank you. Attendance, it's